Hey everyone, welcome to this explainer. Today, we are unpacking something absolutely fascinating from our source material. We're calling it the kinetic blueprint of wealth generation. This source maps out exactly why some folks just effortlessly achieve total financial freedom, while others, who work incredibly hard, by the way, stay perpetually broke. And the underlying philosophy here? It's that money is kinetic. It's literally constantly in motion. So understanding how to direct that motion, well, that's the entire game.
Okay, let's dive right into this roadmap. We'll be breaking this blueprint down into 5 quick phases. First, the mindset of wealth generation. Second, assets, liabilities, and interest. Third, the multiple income stream strategy. Fourth, market crashes as buying opportunities. And finally, achieving ultimate financial freedom.
So, why do some people build wealth while others stay broke? It's a question that instantly creates some tension, right? Because we see it every single day. People putting in 60-hour weeks, totally exhausting themselves, and yet they never seem to get ahead. Meanwhile, you've got others multiplying their net worth without ever clocking into a shift. Today, we're going to strip away all the emotion and look strictly at the mechanical reasons why this happens.
And really, it all comes down to one core idea: working for money versus making money work for you. See, the relentless struggle for everyday folks is basically a physical grind. It's trading hours for dollars in this never-ending, exhausting loop. The wealthy, on the other hand, use strategic leverage. They aren't doing the heavy lifting themselves. Instead, they're directing their capital to do all that heavy lifting for them.
Moving on to Phase 1, the mindset of wealth generation.
Before we jump into the math, we really have to look at the psychology here. The source argues that traditional employment and blind hard work, they actually often lead straight into a debt trap. Think about it. You can run on a treadmill as fast as humanly possible, but you're still just staying in one exact place. Treating a traditional salary as your only engine for financial growth is a massive vulnerability. Hard work alone just isn't enough to escape that paycheck-to-paycheck cycle.
Now, what's really interesting here is the shift in perspective. Conventional wisdom always tells us to just save our pennies, right? But the kinetic blueprint argues that merely hoarding your cash is actually a flawed, defensive strategy. Remember, money is kinetic. So if it just sits there staying perfectly still in a low-yield savings account, it's effectively dying. It's losing purchasing power every single day. To win, you must shift to offensive investing. You have to actively deploy your capital out onto the battlefield.
Which brings us to Phase 2, assets, liabilities, and interest. If that first part was the psychology, well, this is the pure mechanics. It's brilliantly simple. An asset puts money in your pocket, while a liability takes money out of your pocket. That's it. Confusing these two terms is literally the primary reason everyday people stay broke. They'll go buy a luxury car, call it an asset, but in reality, it requires maintenance, it depreciates, it's actively pulling money away from them. The wealthy, though, they relentlessly acquire things that push money back to them, like rental properties or dividend stocks.
So the crucial point is, how do those assets actually grow? 2 words: compound interest. It's the continuous process of earning interest on both your initial principal and the accumulated interest from previous periods. It's basically money stacking on top of money, accelerating mathematically over time. This right here is the hidden, roaring engine behind massive wealth growth. It takes a tiny snowball and turns it into an absolute avalanche.
All right, Phase 3, the multiple income stream strategy. Now that we've built the engine, we need to route all that power. And this brilliantly illustrates the diversified portfolio approach of the wealthy. We're talking the stock market, real estate, and business ownership. You see, wealthy people absolutely do not rely on a single point of failure, like a bi-weekly paycheck. They build multiple streams. So while they're fast asleep, their real estate is appreciating, their stocks are paying out dividends, and their businesses are generating sales.
But, and this is a big but, keeping those streams flowing requires intense financial discipline. You have to aggressively track your expenses, avoid consumer debt traps like the absolute plague, and crucially, reinvest your profits immediately to keep that momentum going. It's a highly disciplined, almost algorithmic approach to daily cash flow, keeping a laser focus on passive income generation.
Let's transition into Phase 4, market crashes as buying opportunities.
We've arrived at a truly pivotal turning point in the source material. Look, everything works great when times are good, right? But economic volatility is an inevitable feature of the system. Imagine this. Year 1, market values are completely soaring. But by year 2, they're dropping fast. And by year 3, they have totally bottomed out. For the average person, this sudden evaporation of wealth is downright terrifying. It's a nightmare of lost retirement funds.
Let's see how this builds, because this is where the mindset shift changes absolutely everything. While the general public reacts with pure fear and panic, rapidly selling off their assets at a huge loss, the wealthy view this exact same scenario as a massive buying event. Because they maintained cash flow and avoided debt, they have the liquidity ready to scoop up premium real estate and stocks at rock-bottom prices. For them, crashes aren't a crisis, they are a massive accelerator.
Finally, we reach Phase 5, achieving ultimate financial freedom.
If you follow the blueprint laid out by the source, this right here is the ultimate goal. Let's quickly recap the steps. Number 1, escape consumer debt traps. Number 2, aggressively build and acquire cash-flowing assets. And number 3, leverage compound interest over time. It is a very deliberate evolution from being a struggling worker dependent on a shift to becoming a wealthy investor whose money operates entirely independently.
And wow, the rewards of this passive income are profound. We are talking about true, sustainable wealth growth. It's about building a private, independent lifestyle where you have absolute family freedom to make choices without any financial constraints. But above all the money, it's time independence. The ultimate luxury described in this blueprint isn't some fancy physical object. It's simply waking up to a sunrise on a Tuesday and completely owning your own time.
The source perfectly distills this entire structural breakdown into one simple, definitive quote. Don't work for money. Make money work for you. I want to pause for just a second to let the real weight of that sink in. It is a complete 180-degree inversion of how almost all of us were taught to operate right from childhood.
So I'm going to leave you with one final provocative thought today. What is your money doing right now while you are watching this explainer? Is it sitting perfectly still, or is it kinetic? Is it out there working for you, or are you just resting before you have to go right back to work for it? Think about how you can put this kinetic blueprint into motion in your own life. Thanks so much for joining me for this explainer, and keep learning.